Hey guys, Daniel here. Thank you for tuning into this video. In this video, I wanted to go over this company that I found. It's called Box Holdings PLC. It's a very small company based out of the UK. Essentially, what they do is they make and distribute, or they make and sell cakes. Very simple, very straightforward. They have about 214 franchise locations in the United Kingdom with a long-term goal of 400 or so franchises, which they likely will achieve over the course of the next 7 or 8 years. So it's a growing company, very simple business. They make cakes at a warehouse, and then they ship them to their stores, and they sell them out of their stores. Their stores are franchise owned, and it's a very simple and beautiful business model. The thing that I really like about this business in particular is the fact, well, number one, it's a growing business. They currently have about 214 stores with a long-term goal of 400 stores. So it's basically a double in terms of their model. The thing I like about it as well is its balance sheet has a very, very healthy balance sheet. It has basically no debt, more cash than debt. In terms of its overall efficiency and margins, it's maintained steady 50% gross margins for the longest time, and its margins have been improving, let's say, a little bit over the course of the last few years. Its free cash flow margin has also been increasing. It puts off about $5 to $5.5 million of free cash flow per year. The beautiful thing about the business really is how simple and straightforward it is. Okay, they have franchises that sell cakes. Very simple business. The cakes are made at a warehouse, at a factory, and then shipped directly to the stores in company-owned vehicles. The store owners don't have to make the cakes there, so the quality control is very high because it's made in a warehouse, and the people love the cakes. Like I'm saying, like if you go on Google and you look up Google reviews for their locations, they're all like 4.7, 4.8, which for a restaurant type business is very hard to sustain, but a lot of their locations are rated like 4.7, 4.8, which is just extraordinary. So the people obviously like the products themselves, and apparently from what I've read online, the cakes are absolutely delicious, and the products that they sell is very high quality. The other thing that I really like about this company is the fact that the CEO owns about 25% of the shares, and he's the founder. So I really like when you have a company where the CEO and the founder is the same person. So you have the person who founded the business, who understands it the best, who's still at the helm, and they have a lot of their net worth in the business. To me, that's very, very important, especially when I'm looking for a long-term compounder like this. So the question is, in terms of this business, like I say, that throws off about $5.5 million a year, let's say, in free cash flow, and managed to pay out about 75% of it on a regular basis, and still grow at about 10% per year. In my mind, that's just a really phenomenal business that requires some attention being paid to it. So if we look at the free cash flow of the business, like I say, like it's throwing off about $5.5 million a year, let's say conservatively in free cash flow. For a growing business like this, valuing it at somewhere around 60 or 70 million conservatively as a fair price would not be uncommon. Now it's selling currently at about 68 million, which is 67 million is what it's selling for currently. So there's not a huge margin of safety in the price. But again, for a growing company like this that is able to deliver huge returns on its capital, I wouldn't mind paying a fair price for it. In my opinion, I'm personally going to wait a little bit to see if I can get it at a little bit of a cheaper price. But I think that even if I bought this company now at the current price, my long-term return would still be pretty much okay, given that we're looking at about 10% per year growth likely. Given that they've already demonstrated that they're able to scale their business model quite substantially. It's a safe business with little debt. Obviously, things can always happen in the long term in terms of things coming out about the business that harms its reputation and so forth. That's always a possibility. But I think in terms of long term success, this is a business that I think it's more likely than not will do well over the next 10 years. The other thing to keep in mind is it's very rare that you can see a business where you can see the future as clear as you can see this business, just because how simple the business model is. Like, we're talking about a very simple idea. They make cakes and they sell them, right? It's not complicated. People are going to eat cakes in 10 years. And the fact that we can predict reasonably well that in 10 years they're going to have about 400 stores, and we know roughly how much revenue per store and what profits are looking like, on a per store basis, we can roughly estimate how much it's going to be making in 10 years time and see what our return is to us as investors. So just going over some basic numbers here. 2023 they did 35 million in revenue, 4.5 million in earnings. If you look at the free cash flow, it's about 5.5 million. In terms of their balance sheet, it's quite healthy. They got more debt than cash, about 4 million in net cash they have, and a very healthy current ratio as well. Overall, this is a business that I really like. In terms of what sort of when I would get into a position, like I say, if we're looking at a market cap of about 60 million, I would be extremely interested. So it's just a business that I'm keeping my eye on. I expect you to always do your own due diligence for companies like this, but it was something that I thought I would share because it's an example of the type of company in terms of long-term compounding that we should really be looking for, which are things that are simple business models, very predictable, at good bargain prices, where we can see the future 5 to 10 years down the road and say, okay, this is a company, 214 stores, they're opening 24 stores per year. They said that their long-term goal is about 400 stores. They've proven that they can already scale to 200, and we see where exactly they're planning on putting those other 200 stores that they're planning on building. And we know that the same store sales have been relatively consistent, and that the people like the product, and so on. So this is the type of business that we'd be looking for. And the way that you approach it is very straightforward. You look at, okay, with 200 stores, they put about 5.5 million per year in free cash flow. In 10 years' time, they'll have double the number of stores, maybe even in 7 years' time. So they should be able to put out 11 million. Now, they'll have more free cash available when they're spending less on capital expenditures to expand the business. So maybe instead of 11 million, they'll be able to have 12 or 13 or even 14 million dollars a year in free cash available for distribution to the shareholders at that time in 7 or 8 years down the road, depending on what direction the business takes. So if in, let's say, 7 years, they're putting off about 14 million, how much would we be willing to pay now? And there's no easy answer to that question. It really depends on what you as an investor are comfortable with. Like I said, for myself, I think if I can get the whole business for 60 million, I'd be very happy. So just take a look at it. You do your own due diligence, and let me know in the comments what you think. Thanks.